So welcome along everyone to our farm advisory webinar for new entrants to agriculture on business planning. So tonight we're going to be covering all aspects of business planning and having a peek at understanding accounts as well, because the topics go hand in hand. So tonight's webinar, we're lucky enough to have Alice Wilson with us from Galbraiths, and she's also an AMC agent. And you've also got myself, Kirsten Blackwood. I'm based in the Ayr SCC office. So tonight we'll be covering what is business planning, why have a business plan, and what would you include in one. And also, like I said, we'll do a bit on understanding accounts. So at this point, I'd like to pass over to Alice. So if Alice, you can take the control of the PowerPoint and take us on from here.
Perfect, thanks Kirsten. Welcome along tonight everybody. So as Kirsten said, I am Alice. I work for Galbraith as a rural surveyor. I am also an AMC agent, so I provide funding applications on behalf of farmers, and business plans are quite important with regards to that. Okay, so for some farmers, creating a business plan feels like a hindrance and a headache, but a business plan is like a flight path. It lets you know where you want to go, what you want to achieve, what you have to do in order to achieve your goals, and probably most importantly, what problems you can expect to see along the way. Farmers that write a long-term business plan are often more profitable than those farmers that don't. Writing your ambitions down is one of the most successful ways to visualize what you want to do, and therefore you're more likely to be able to achieve that if you have a good understanding of what your objectives and visions are for the future. So why plan? There's a multitude of reasons of why you should put a business plan together. The first is it allows you to assess and manage risk. For example, it may allow you to understand how you can stay within your overdraft, which is most important in this current climate. And equally, it also gives you a good indication of when is the right time to invest. It also allows you to identify resource implications. So that could be machinery investment, how much HP you've got on the go. Do you have serviceability there in order to carry more HP? Do you use your own labour? Do you use outside labour? And is there any sort of off-farm income which could contribute towards sort of finance or serviceability? And it also provides a helpful framework for any sort of day-to-day decision making. It gives a solid basis and it provides confidence that you as a farmer are, doing the right thing. And you need to, it's so important that once you do a business plan, it just doesn't get chucked in a drawer. Like, have it on the table, have it on the kitchen table, and refer to it on a regular basis. It's no good if you put the effort and resource into planning one if it just sits in the office drawer and is not used to the best of its ability. So a business plan is a formal document which will help you explain where you want your business to go over the next few years and how you can plan to achieve your goals. Producing a business plan will give you the opportunity to think in depth about the challenges your business may face and how you might overcome them, making you more prepared if these issues do arise. It also gives you written targets to aim for, review, and monitor. So if things start to go off track, then you have the ability to correct them relatively quickly. So what is included in a business plan? There's various things that can be included. Obviously, you need a sort of key introduction. That's about your farm, do you dairy, are you arable, are you beef and sheep? It's just sort of a basic outline of what your farming enterprise is. And then For example, if it's for a farm business tenancy, you may want to go on and see what your proposed sort of ongoing farming policy would be. So in terms of your stock numbers, your cropping, do you have a requirement for forage or reseeding, so on and so forth. It also touched upon your capital requirements. So you obviously need to think about your finance essentially, and Kirsten will touch upon that later and how accounts come in very handy within a business plan. There's obviously a few reasons why a business plan should be required. It's an essential tool if you're seeking to develop your farming system through expansion or major investment or a different enterprise mix. It will be helpful if you want to forecast what the future holds for your current business, even if you're not proposing any major changes. You see on the screen there some examples of where you would require a business plan. Any sort of farm business tenancy, 10-year MLDT, even a 5-year, most agents who will be acting on behalf of the landlord these days will ask you to pull together a business plan as part of a tenancy application or a tender pack. So you would need to fill out a business plan about what your vision is for the farm, where you see your income being, where you see sort of your costs are, so your fixed and your variable costs. And then that obviously allows you to sort of give an indication of the level of rent that you would be able to be prepared to pay in order to, run that tenancy, and that will be based on what your business plan states. Another sort of key reason why a business plan would be required is for any finance application. So if you're seeking a bank loan or a mortgage to purchase additional land or farm, or if you're altering the current farming system. So for example, you could have a complete change in direction. You could be currently running a beef herd, and you could then have a vision to start milking dairy cows. So again, a business plan is key there in terms of when a finance company or a bank would want to lend you money, because it gives them an indication of where's this money going, how can you make this work, and they're not just lending you money on the basis that you're going to go dairying. It shows an overall picture of how you're going to run that business. And as Kirsten said earlier, as I'm an AMC agent, we often do look for a business plan which is supported by budgeting as well. And within that business plan, we would analyse the budgets that have been prepared, and assumptions would be made. We would look to test them. So we stress test any sort of budget which is created. So for example, if a budget is pulled together and you're milking and it's done on the milk price, and you've for example, you've assumed that you would be on 32 pence per litre, we as agents would stress test that and bring that back, and we would see if the finance or the business still worked, if it could still service the cost of the finance. And that's where sort of business plans are key in terms of lending money, because for example, AMC lend and leave. So once they lend you money, they need to be comfortable that you can meet that servicing cost. So if you've got a strong, solid business plan with vision, objectives, with good assumptions at what your level of income and what your outgoings are going to be, then they're more likely or perhaps willing to lend you money, as opposed to some Tom, Dick and Harry who has no business plan and just wants to borrow £1 million to go from beef farming to dairy farming. So it is essential in that fact. But again, just because you might not be applying for a tenancy, you might not be wanting to, borrow money, a business plan is equally important just as a general management tool. As I said earlier, it's something that, you can refer back to if you think that if your accounts aren't good one year, you can refer back to your business plan and sort of, sit down and think, right, where am I going wrong? What can I do better? How can I improve? And as I said, it's not something that sits in a kitchen drawer. It needs to be something that's referred to on a regular, basis, whether it's, in your quarterly meetings, whether it's something that your accountant or your farm advisor also has their hands on. It needs to be something which everybody is aware of and can be referred back to. So, vision statement. So a vision statement will explain to readers where you want the business to be in, say, 5 years' time or longer. It can be based on your personal objectives and perhaps those of everybody involved in the management of your business. For example, a dairy farmer's vision might be to expand from 125 cows to milking 200 cows, whilst introducing 3 robotic milkers, all while maintaining or increasing current profitability levels, but also having a better work-life balance. But then equally, a business plan can be a useful tool for, say, a tenant livestock farmer whose vision is to essentially retire from the farming business within the next 5 years, and it will show them how they best maximize the cash that can be released from the business over that period of time. So it is essential to write down your vision statement of where you want to see your business in 5 years' time, and that gives you something to work to. And then once you get to that 5-year period, you can assess what you achieved and then what you want to do going forward. So there's sort of 2 main economic tests when we look at business planning. There's obviously the worthwhileness, which is profitability. So if you're, is the objective you have, is it worthwhile? Is it going to bring in, more money? For example, increasing your milking herd from 125 to 150 cows, is that going to bring in profitability to the business? Or will, in doing so, your feed costs might actually increase? So you only balance out at the end of the day, how worthwhile is it to the business? And sort of the next key thing is obviously your feasibility and your cash flow. Having sort of a plan gives you a good indication of where, for example, your cash flow, well, most farmers probably work with a seasonal cash flow, so it fluctuates at different times of year. When for example, your subsidy payment comes in at the end of the year, cash flow is obviously slightly better because there's more money to play with. But having a business plan in place certainly allows you to have a look over the sort of accounts and your budgets to see when there's money, and also allows you to plan for any capital requirements. And that can be, your drainage, your liming, your fencing, and you can plan that around time where cash flow potentially permits, obviously. But also you need to take into risk, practicality as well, and then your personal preferences. I said earlier, you've got to be able to use realistic assumptions. It's all, very fine and well saying that, you would achieve 32 pence per litre for your milk. But I think milk volatility is probably one of the biggest risks at the moment when lending money, certainly from an AMC perspective. So as I said, we do bring that back and we make sure that the figures still work if, for example, milk price was to come back. And it is important to be realistic in assessing your business development, the market as well. You need to have a good understanding of where the market is at. Obviously at the moment, prices are through the roof, even just steel prices. If you're looking to put up a new, just a general purpose shed, you're looking at almost, goodness, I think 40 or 50% more on what you'd have paid 6 months ago. So it is key to understand the market and any sort of future opportunities. A business plan which is unrealistic or sets unachievable targets is in fact sort of no use to anyone. It sort of defeats the purpose of pulling a business plan together. And again, it's probably important to touch upon the fact that a business plan can be as much about standing still or even contraction. Growth is not always essential. If you're happy farming and you think you're farming in the correct manner and it's bringing in the profits that you would like to see, and the business plan is just there as an aside and a management tool to follow, then again, that's also important. It doesn't, as I said, doesn't need to always be about growth. So another important part of a business plan is obviously understanding where you're at, and that's where a SWOT analysis comes in. It's about identifying what your strengths are. So what are your advantages within the business? What do you do well? What do you believe other people see your strengths as being? And also consider this from your own point of view and from the point of view of others that you deal with. And as I said before, it's always important to don't be modest, be realistic. Again, it also allows you to identify what your weaknesses are. So where could you improve? What do you do badly? What should you avoid? And again, I think if a farmer said there's nothing that I can improve on, I think they'd be lying. I think there's always room for improvement, whether that's cutting a percentage of what your feed costs are, or, you know, trying to increase your butterfat content or your protein content. You know, I think there's always room for improvements. It also allows you to identify what opportunities there may be. And certainly at the moment, sort of the opportunities open to farmers are, you know, certainly in Ayrshire, there's a big thing at the moment about forestry planting, which is a big thing if you know, if you're on sort of poorer ground or the more marginal ground. Forestry investors are picking up that ground quite quickly and able to pay a premium. But certainly if that's not something you would want to look at, then there's other opportunities, such as it could be putting up wind turbines or diversification. Look at the likes of Morton's milk or Mesquite milk. They've diversified and used the opportunities that were presented to them at that present time. And it also allows you to identify what skills that you might require going forward. Is there something, a gap in your knowledge or your understanding of something? It allows you to identify where that could be. And lastly, obviously, the threats. It's what obstacles do you face? Are there required specifications for your job? Products changing? Is there changing technology threatening your position? Do you have bad debt or cash flow problems? So it is worthwhile doing a SWOT analysis, because it will give you a good understanding of where your business is at, or what you would like your business to be, essentially. So what are objectives? So objectives are shorter term goals which allow you to monitor performance against your plan, and there should be SMART effectively. So SMART being the S being specific, so have an objective that you can focus on, which is not vague and difficult to achieve. Again, I've said it before, it needs to be measurable. They should be reviewed on a regular basis, and action should be taken when you feel that you're veering off the target for meeting your goals. Equally, they need to be achievable, so you and your business should be able to meet the objective within the deadline set, even if it's challenging. They need to be relevant, so think about the vision of your business and the mission, and ensure that your objectives obviously work towards these. And then lastly, time is always important. So ensure that there's obviously a deadline to work towards, which can then help you achieve the objective. The sort of risk matrix and the SWOT analysis will help you develop your objectives by giving you areas to focus on. And then obviously, as I mentioned earlier, having sort of one-to-one meetings or regular team discussions can help you meet your objectives by ensuring everybody is clear of what is required of them. On the next slide, we have just, for example, 2 SMART objectives. So obviously one of them could be you want to generate net profit that exceeds drawings. So generate a net profit of 10,000 in excess of personal drawings by the end of the financial year 2021. And then a really simple non-financial, well, I can't say non-financial because it obviously will help profitability, but obviously to achieve a better landing percentage on what you did on the previous year. So your objectives can be anything. They don't need to necessarily be financial, but anything you probably do, such as your landing percentage, will link back to the profitability of the business. So benefits of the objectives, obviously it gives you purpose and direction. It allows you to focus on the important things and the things which are key to the business at the time. It also helps you recognise problems that will affect the objective being met. And it is important to have a sort of success criteria in place because it allows performance to be measured, and you know, if you've got that in place, somebody is more inclined to meet that objective if they know that it's going to be reviewed and spoken about on a regular basis. And it also means that, you know, a discussion allows you to actually buy in and you're taking ownership of that objective. And obviously it's a better communication of business goals. So taking action. As I said, good way to identify and plan the actions you want to take, without obviously reiterating too much. If you commit to something on paper, then obviously you're more likely to carry it through if you know that it's written in black and white, and you can't necessarily get away to it. It's a good reference point, essentially. So in short, the main points are: identify the issue, what do you aim to do, how are you going to do it, who is involved, when are you going to do it, and when are you going to achieve it by, and how do you progress and monitor the situation. That's my slide finished, Kirsten. I can pass you back control. That's probably the easiest thing. But if anybody's got any questions, we can either do it in the chat box just now, or we can wait for Kirsten to go through her sort of understanding accounts and analyse side of things.
Perfect. Thank you very much, Alice. I'll just see if any questions come through. I see that someone's asked if the presentation will be available. Yes, we will make it available. It's being recorded, so we'll have the recorded version available through the Farm Advisory Service. I've seen that someone had their hand up there. Let me see. I don't see any hands up now, but if there's any...
Is there a template business plan available by chance, Kirsten?
Yeah, there is.
Wondering, yeah.
Yeah, that's a good point. I've got a slide with all the links at the end of the presentation, and there is on the Farm Advisory Service, there's actually a lot of good templates and tools on there that can help you do your own business plan.
AMC have also got, I think on their website, they have a good 2-year budget plan as well. I know Kirsten's going to talk about the account side of things, but they have a very simplified 2-year budget template, which can be quite helpful in assisting with a business plan.
Brilliant. Okie doke. Well, that's it. Alice's part sort of done. So I'm just going to talk briefly about understanding accounts, because it is part of business planning, really. So first of all, how profitable is the business? How much is the business worth? How strong is your cash flow? And how shockproof is the business? These are like really important questions when considering doing a business plan. And how shockproof is your business? Alice mentioned before about doing sensitivity analysis and you know, bringing back your milk price or your lamb price to see if the business can still survive and still make all its borrowings and payments, etc., with a lower income. So 3 key elements to accounts. There's cash flow, profit and capital. So you'd only really see profit and capital mentioned on a set of accounts. However, cash flow is really important for business planning and creating forecast budgets. Like Alice also mentioned, you know, finance companies and for tenancy applications as well would like to see forecast budgets just to see if you can make your payments and what your plans are going ahead, to see your income and your outgoings. So that's why cash flow is very important. And they usually ask to see 2 to 3 years projected cash flows. So a profit and loss account, most of you will have seen these before, especially if you already have a business of your own. So just to run through this very quickly, the output at the top is all your income. So that would be all of your stock sales, crop sales, subsidy income, etc. Next down, you've got cost of sales. This can also be called variable costs. And basically variable costs, they sort of tend to go up and down in line with how much stock and how many crops you've got. And then after that, you get your gross profit, which is basically just all your income minus the variable costs. And then next down, you've got overheads, which can also be called fixed costs. These tend to be more static. So that would be the likes of your labour, which would be employed labour. So like your salary that business partners, or if you're a sole trader, the cost of your salary won't be shown here. It is just employed labour. You can also see depreciation. There's a cost in there, even though you know, if you've got machinery sitting, a cost is factored in to the profit and loss account for depreciation of that asset. And you can also see their interest and finance charges. So if you've got a bank loan or an overdraft, the interest element will be shown in the profit and loss account. However, the capital repayments are not shown here. So basically, after you take off your fixed costs, you get your net profit. And what are you in business for? You're in business to make a profit before depreciation that covers your cash needs. And just like I said there, your cash needs is your personal drawings, including life insurance, personal pensions, tax, reinvestment, whether it be in the business or not, loan capital repayments. So like I said, just the interest element is shown in the profit and loss. So the actual capital repayments have to come out after the net profit, if you like. So that net profit has to cover a lot as well. So it has to cover all these cash needs. And what you can find as well is go off an average profit before depreciation. If for business planning purposes, because you might have a year where you are making a big investment, and you know, your net profit might be lower than what you would usually expect. So for planning purposes, I would use a 3-year average, and that's what we tend to do as consultants when we're doing business planning. We usually ask the farmer or the client for 3 years, 3 sets of accounts, and we'll work off of those. So some of you may have heard of gross output analysis. This is something that is included in most business plans that we do, and when there's sets of accounts available, obviously, if you're a proper new entrant and you've not yet set up a business, obviously you won't have any accounts to analyze. But if you have had a few trading years under your belt, then we would include these in a business plan. So this table just kind of shows the targets. So your gross output is of your income, and then you've got your variable cost to take off, and then your target gross margin should be around 60 to 70%. And then after that, you take off the fixed costs. And one thing that we quite often see is labour and power machinery. Sometimes it depends on the farm business, but you might have on a farm business just 1 or 2 family partners working in the business with no employed labour. So labour would actually come up as 0 there, but they may have bigger machines and equipment to help deal with that lack of labour. So we can sometimes see power machinery up at 30%, 35%, and labour at 0. So if you can just kind of combine these 2, then you'll get a better idea. But I see there's a question from Sandra. Let me see. Sandra, are you able to type in the chat box or the Q&A box, and I'll answer your question? That would be great, thanks. And there is, at the end of it all, you're hoping for 15% or more in net profit. Okay. So on the, like I mentioned before, I've got a useful link slide at the end of this, and on it are links to all different things, but one of them is the Farm Advisory Service business tools, and on here you can actually type in your figures from your accounts for the last 3 years, and it will calculate a gross output analysis for you, and you can quite easily just put that in your business plan straight from that spreadsheet. And as well as that, it's worthwhile doing anyway, just to see how your business is performing, and where you can maybe improve on. So I'll go on to the balance sheet next. So the balance sheet is just really a snapshot of the financial position of the business at the end of the financial year. So you can see in the red box at the bottom, there is net worth, which is assets minus liabilities. And when you look at liabilities, Under current liabilities, we've got creditors, the bank overdraft, and leasing and hire purchase. We tend to put any debts payable within a year under current liabilities. And I know it's quite easy to say, oh, I've had a bank overdraft for years, but bank overdrafts are usually unsecured, so the banks may ask for that money back at any time. So that's why we put it in as current liabilities. The other thing I would mention there is up at the top under fixed assets, there is heritable property. So quite often in accounts, we'll see that figure being quite low, a very low valuation on it might well be a farm that you own. And the reason for that is that it will be the last time it will have been valued. So if that farm's been in the family for generations, that figure will be very low and not its actual market value that it is today. So it's also worth putting in a sort of farmer's balance sheet in the business plan as well, if you've had a more recent valuation for the farm. So long as you're realistic, I think you're okay. But yeah, sometimes a lot of these farms are valued far below what they actually are in the balance sheet. Okay, so I'm going to ask you a wee question after this that you can all put in the chat box, but just so you know what you're looking for, I'll go through this. So cash flow, a business with cash flow issues is usually you can tell through their farm accounts or their business accounts by these trends. So if their creditors and debtors are increasing and their bank balance is worsening, and if they're struggling to pay off their loans and their finance, they're having cash flow issues basically. Whereas a business with a strong cash flow, they usually have low creditors and debtors, an improving bank balance, they're paying off their debts well, and they're actually saving and investing in the business. But again, like I said, one year in isolation can tell a different story to the overview of the whole business. So look at it over a few years in general. So here's one example. So my question to you is that the McDonald's balance sheet here, what conclusion would you draw about their cash flow position? So if you could type in the chat box if you think they're in a good cash flow position, if they're under pressure, or if they're poor. So you can see that their fixed assets are more or less the same from this year to last year. Their current assets have dropped slightly. Maybe valuations can be trading stock, so maybe they've just not got as much trading stock as last year. Current liabilities, you can see their creditors is creeping up slightly. Their bank overdraft is creeping up slightly, although they've not got any leasing and hire purchase in the current year. So in the long-term liabilities, you can see that they have paid 5,000 off their long-term loan, and the overall net worth of the business has reduced slightly. So if you're able to type in the chat box if you think they're good, under pressure, or poor, that would be fab. So Sandra thinks that they're under pressure. Are there any other? Gath thinks they're good. Rachel, under pressure. Amy thinks they're good. Yeah, it is quite a difficult one, to be fair, because they are paying off their loans, so it's not an easy one to say. It's all a bit subjective, I suppose. So personally, I would say that they're under pressure. So although they are paying down their bank loan, you can see that their bank overdraft has went up nearly 7 grand. To the untrained eye, you would see your net worth is looking pretty good at the bottom there, but you know, the bank overdraft is creeping up, meaning that they don't really have the cash to reinvest, and you know, without borrowing more. So that's my reasoning there. Also, their creditors are they're still low, but it depends on the type of business it is. It is increasing slightly. So I would say they're under pressure, but at least they're still able to pay off their long-term loans. But it just depends on their overdraft limit. You know, if their overdraft limit was 110,000, then if they had another year like that, then they would be in trouble, basically. So that's what I would take from that one. See, we've got a question actually. It's Kate saying under pressure. Well done. So cash flow, good profit and good net worth doesn't necessarily mean success. So like I said, you need to cover your cash needs, pay your bills when they're due, your personal expenses and capital spending. So how good is cash flow? Don't worry, I know this is a horrible slide, but it's just to show you the layout of a cash flow in case no one had seen it before. So you've got a page for your cash inflow, so that's all of your income. So down the side, you've got all your lamb sales, your cow sales, calf sales, subsidy income, etc. All the different categories, and it's split up into every month of the year. So for a forward budget or a forecast budget, you would put in your expected income in each month for each category, and it's the same for your outflow. You know, your vet and med payments, your fertilizer bills, feed, etc. All those costs. You put them into the projected cash flow as to when you expect those payments to go out and how much. So at the bottom of the income and the outgoings, you get a net cash flow. So that is basically just the income minus the expenditure, and you get your net cash flow for each month of the year. And at the start, you'll have your opening bank balance, and the net cash flow will just feed into that to see what your closing balance will be each month. Hopefully that makes sense. So this is just another way of seeing the closing bank balance for each month. So it's a really good visual because you can see that they're in the black, they're positive for months September through to January. However, they're in the negatives for the rest of the year. So that's where they need to source finance for, whether if it's an overdraft or a secured loan. And generally, I'd say an overdraft is good for a business where you are in the negative for just part of the year, or just temporarily. Whereas if you're going to be in the negative for a good length of time, a loan would be the best way to go, because it's secured, and you know, the bank can't ask for that money back at any time without good reason. So here's the useful links slide. A lot of good stuff in there if you're wanting to have a go at business planning yourselves. Mostly through the Farm Advisory Service website. They've got templates on there for different sections of the business plan. They've got tools to benchmark your accounts, like the gross output analysis. There's also the Scottish Farm Business Survey gross enterprise tool. So it's really good, especially if you don't have say a certain category of stock, or if you don't have any stock at all at the moment. It's good to have that as a benchmark, and you can get figures from that to use in your business planning to slot into your cash flows as well. So there's actually example cash flows in there and a blank template. I've also got a link there for our SAC Farm Management Handbook, which is great for getting guide prices and costs for your cash flow as well, and to also benchmark your own performance. Lastly, I've put in a link there to another webinar recording, which goes into more detail about understanding accounts, if you want to learn more about it. So just to summarise this webinar, planning is an essential part to any business, and it's important to assess both financial and non-financial aspects of a new and an existing business. Options for budgeting depends on the situation. So whether if it's an enterprise change, like Alice said, from beef to dairy or dairy to beef, or if it's a major investment, such as if you're putting up a new shed, or you're buying land, etc., you may need a business plan. Also, if you were doing a business plan as part of a tenancy application, you know, you're trying to show your strengths and the opportunities you could do with that. You know, when we're talking about the SWOT analysis, you're just trying to show what you would do with the farm in terms of reseeding, etc. You know, you're trying to show yourself in a good light, really, for a tenancy application, while still being realistic with your figures. And of course, with cash flows, you should budget it, see how you're getting on month to month, year to year, budget, monitor, and update it if necessary. It's a great management tool, I can't say enough about it. And there is funding available through the Farm Advisory Service to help you with some of this. So it's called an Integrated Land Management Plan. It's a bit like a business plan, and it's about it's available to anyone who has a BRN number. So that's anyone who's set up with SCRPD, or the department you might know them as. So you can get 80% grant funding up to £1,200 for an integrated land management plan, and it's great for businesses that are perhaps at a crossroads. You know, perhaps they're wanting to look at options of other stock, or whether if they should be taking rented land or not, etc. You know, it's a really good way to look at your options and see what suits you best, and what would be your best option. A lot of things we've talked about tonight are included in a integrated land management plan, including the analysis of 3 years of accounts, and a good discussion with the farmer, actually, just to see where you want to go, your sort of vision statement, and take it from there. There's also specialist advice plans, funded up to £1,000, depending on which one you go for. I'd say your best protocol is to have a look at the Farm Advisory Service website to see if any of those would be of interest to you. And lastly, there's carbon audits. These are becoming more and more popular. So especially, you know, a lot of dairy contracts will, you will actually have to do one of these for your, as part of your milk contract. So they are getting more popular with beef and sheep farmers as well. So you can get your first carbon audit 100% funded, and subsequent ones funded for £250. And you've got access to an accredited advisor like myself and my colleagues at SAC. And yeah, it's not taking advantage of enough. A lot of these grants, you know, they're there to help improve your business. Even the carbon audit, you know, even if you're not interested in, you know, your carbon footprint, it tends to be those businesses with the lowest carbon footprint that are the most profitable. So it really is all about, you know, business performance and improving profitability as well. So so the links there at the bottom, like we said, would circulate the presentation at the end, and I just advise you to have a look on there and see if anything's of interest. So I see there's some questions there. Let me go to the Q&A box. So where's the best place to find out what funding grants are available now and what's in the horizon? So the best place to look is, well, you can look at the Farm Advisory Service for those grants I've just mentioned. You can also go on to rural payments and go on to there. If you click on the link that says all schemes, then it'll come up with all the sort of grants available on there. And that will include the likes of your basic payment scheme, your young farmer top-up grants, agri environment climate change scheme, you know, all of the sort of environmental grants, etc., small farm grants. They're all available on there. Otherwise, if you can always contact the Farm Advisory Service helpline, and they will put you through to an accredited advisor who can help you and let you know what grants are available. So for the likes of budgeting, this is the next question. Are the figures on the SRUC handbook accurate, realistic enough? They are, because they're reviewed annually. The Farm Management Handbook is it's reviewed annually and updated. So the link I've got in the slides is the 2020-2021 handbook. So they're the most up to date, and they are from real farm data. So I would say that they are probably the most accurate you can get if you don't have your own data to go by. If you've got sheep already and you know what your lambing percentage is, you know what your prices are and your costs, use them, because that is more that will be more tailored towards you and what your farm is capable of. So that's a good sort of starting place if you have your own figures, go off them, and if not, go and use benchmarking tools and figures such as the ones in the handbook. Does that include diversification? I'm not quite sure what that's referring to. But if you can maybe give me a wee bit more on what you mean by that, that would be great. But of course, you can include diversification in your cash flows and in your business plan. And the likes of your opportunities as well. Say if you're taking on a farm tenancy, you can mention that you know, you may let out the annex as a holiday let. You might renovate something and do something like that. You might do glamping pods or whatever. You know, it's all to be included and up for discussion. So sorry, the ILMP. So it is farm-based, but yeah, you can definitely look at diversification as an option. So it would analyse your business as it is currently, and then you can look at, say, maybe 2 or 3 options of where your business could go, or, you know, 2 or 3 options that you'd like to look at. And if diversification is one of them, then you can certainly cost that out and see where, if that's worthwhile for your business. And if you apply for the ILMP through the Farm Advisory Service, like I say, you'll get an accredited advisor. SAC consultants are some of the advisors that they use. So it may well be that you would get referred to one of us. Is there any funding available for new start businesses at the point of not having a BRN number? A landowner at the point of setting up an agricultural business. Well, for the Farm Advisory Service, you really need a BRN number. It's quite easily to set it up. You know, we can quite easily set that up for you, even if you haven't allocated land to it yet. So get you registered with SCRPD, also known as the department, as a business. So you've got a business reference number, even if you don't have the land associated with that business yet. So there's ways and means. Feel free to chip in, by the way, Alice, if you've got any, if you want to add anything.
No, Sandra's asked, I get confused about what to liaise with their SEC farm advisor and FAS advisor about, and normally just contact their SEC advisor. Where's the sort of split in, you know, communication, Kirsten?
Sure. So if you're a subscriber with SAC, go straight to your advisor. However, if you don't have an SAC subscription with us, you should really go through the Farm Advisory Service, and they may well pass you on to us or another advisor. But yeah, if you're a subscriber to SAC, you can go straight to us, and we can advise you on what farm advisory grants you could maybe apply for as well. So yeah. So if there's no final questions, I'd just like to thank you all very much for joining us tonight. I'm sure you'll agree that Alice has been a great speaker talking about business planning. So I just want to say thank you again and have a good night. Okay, thank you.